Thursday morning. Welcome, everyone. Um, we just want to say thank you for everyone that could join us today. A little bit of a quick introduction of who we have on the call. My name is Catherine Jones, and I am EQK's Investment Relations Manager. We also have our esteemed EQK president, Gus Van Dender, on the call with us. He is going to be answering as many questions as we can throw at him. And today we have a special guest. So today we actually have Jake Carpenter, who is an investment advisor, and he is an expert in alternative investments. So he is not part of the EQK team, but he has been sending some clients our way and been helping us out with our raising. And so we thought that we would bring him on board so that we could ask some external questions to him. So today, everyone gets a special opportunity to ask any questions they like, so we can take those through the Q&A session. The Q&A where you ask those questions is down at the bottom of your screen, and it actually says Q&A. We're not doing the chat, we're just doing the Q&A. So if you have any questions along the way, please feel free to post them, and we will get started. All right.
Thank you,
So
Kat.
you're
Can I
welcome.
just say, I'm going to say I defer that question to Jake today. That's just
Oh,
going to be the standard answer.
that'll be an interesting one. Yeah, that'll be great. That'll be a lot of fun. Jake, you're going
Jake
to be in the
knows
hot seat.
better. Yeah, he knows better.
Right, right.
You're excited to do my best.
I know, I just work here, you know?
Perfect. Okay, so one of the things that I'd like to do just before we get started, which we typically do on every call, is we just give a little bit of an understanding of what we are offering. So for any of those that have not actually downloaded the business information pack, this is just going to be a very, very quick snapshot. So EQK is a holding company. We are in the process of purchasing different companies and putting those into the holding company. And right now we are offering a promissory note. We're offering those notes in 2 or 3 year terms. And depending on your investment amount will depend on the percentage that you get. If you are investing anywhere, sorry, our minimum investment is 50,000. So if you are investing anywhere from 50,000 to 250,000 on a 2-year note, you would get 16%. On a 3-year note, you would get 18%. And then if you're going above the 250,000, then you get a perk. You get 18% on a 2-year note and 20% on a 3-year note. So that's just the background, a little bit of background. And then today we are going to be talking a little bit about the companies that we're investing in, and also why would we want to invest in this? What is the company about, and get a few more details about the different companies that are inside as well. All
Yep,
right.
I'm
So
ready.
did I hit all the points? Is there anything I missed?
No, I want to add that I'm actually at the airport right now. So I want to tell you guys how dedicated I am to being here. I'm in a phone booth waiting for my flight to Austin, Texas. It's important to me, and I just want to share that with you, right? It's not just something we do on the side. This is what we do. Like, this is what I live, breathe, and do every single day. And I couldn't be more excited about what we're up to, and just the feedback that we're getting from people that we're having conversations with about acquiring their business, after we acquire their business, their participation in everything. And yeah, I just wanted to share that with everybody on the call. This is more than just, oh, let's go raise some money. This is a long-term dedication to building something great.
Absolutely. Absolutely. So just to start us off, could you give us a little bit of a snapshot of the type of companies that you're investing in?
Yeah, very important to know, actually, because there's so many different types of companies, and a lot of people probably have kind of a belief system around what a company is, right? You start a company, or you have a company, you've worked in it for 20 years. There's high expenses. You always have to deal with employees. right? And people leave, and then you have to hire, and then you have to, there's so many things around owning a company or running a company that people have a belief system around based on their experience, right? Maybe as an employee, you've seen all the stuff behind the scenes and you're like, oh my God, I would never want to run this company. Well, neither would I, to be honest. So it's important to note that in this roll up and future roll-ups that we're already anticipating, we're looking for, call it easy companies, right? Companies with very few employees, companies with no inventory, companies with no storefront, with high rent or office space or you name it, right? And those exist, especially now, especially after the pandemic, where a lot of people had to figure it out. How do I work from home, right? And how do I make a living without that office, without going to that office, without that inventory? Now that's where you see Shopify stores and drop shipping from Amazon and real estate and all of that stuff. So the vertical that we're interested in and investing in right now is what we call the info space, online information, online teaching, courses, education. And it's big. It's a big industry. It has been there for a long time. It has been given a boost during the pandemic, obviously. A lot of people got in as a student because they had free time on their hands, but a lot of people also saw the opportunity to step in as a business owner and starting something that they can run from their living room, right? With a laptop. Like this whole idea of the laptop nomad is real, right? I lived in Costa Rica for a year. There's hundreds of people there running a business, including myself, from Costa Rica. I mean, I was doing my Zoom call, you know, those Zoom backgrounds with the palm tree and the ocean? Well, that was real. I had that real background, and I lived there for a year. So, and I'll go back because we're building a house there.
Yeah.
But that is a new industry that is actually very young still. There's a lot more to do, and projections are massive into billions of dollars, right? So what we're buying is companies that offer an online product, an online info product. Now, very important distinction. What we mean by info product is something that I can deliver a million times without adding resources. This is not coaching, right? If and we're looking at these things too, but we're not necessarily acquiring them, we're adding things on. If I were to buy a coaching program, let's say, Jake has his own coaching program teaching people about alternative investments. Well, how would I buy that company? I couldn't because it's Jake, right? Jake has a following. Jake is on Facebook, on Instagram, on TikTok, and has followers. His followers want Jake. They don't want Catherine all of a sudden. It won't work. So I can't buy Jake's company. However, if Jake has a video course that people buy for a low amount, right? And then eventually maybe they ascend into one-on-one coaching. That is interesting to me. Why? Because I can keep selling it. And Jake's following is also interesting to me because if I know they're interested in alternative investing, I know they're probably interested in products around taxes or setting up LLCs and trusts and anything around business and right. So why does this work? Because of the consolidation of products and the consolidation of in people, in followers, email addresses.
Right.
Because the more products I own, the more email addresses and followers I have, the more I can sell and cross-sell into that same ecosystem, right? So that is really the crux of what we're doing. Now, one additional thing that I want to add is what we're accomplishing, consolidating these things, owning these products that we can sell to more people is nothing new. It's already happening, right? Jake, with his product and his following, is already working with Catherine with her product and her following. Why? Because Jake can make a commission on promoting Catherine's product to his list, right? So if you have a product that is seems interesting to your followers, you can go sell that, take 40% commission. So it's already happening.
Yeah.
The cool thing, I was looking for the right word without sounding too you know, whatever. The cool thing about what we're doing is when I own both Catherine and Jake's product and list, I don't have to share with anybody because now I get 100% of the revenue instead of 60 for Jake, 40 per Catherine when he promotes her, 60 for Catherine, 40 for Jake when she promotes his. I
Right.
buy both, I have both lists, I have both products. I now keep 100% of everything. And that's really what we're doing. And that's why we often get this question. And Jake actually called me with a concern about the 20% interest on the promissory notes, not for him, but from a party that he's working with. Yeah, it's high, but why am I able to do that? Because of this only. The 40% or 60% becomes 100% when I buy it. And there's so many more things that I can do to increase the profitability, but just there alone, you can already tell that by acquiring two companies, I can increase the profits on both sides.
Right, right. That is a common question that we get, which is how can they afford to pay
Yeah.
out such high commissions? And so another question that we get quite often, people get a little bit confused by the EQK holding company. So when somebody is purchasing a promissory note, they want to know, are they purchasing specifically in an individual company or are they purchasing within the actual EQK holding space? So could you explain how that works a little bit?
Yeah, you could look at it both ways, right? If it sounds more comfortable to you to say my 100,000 is being used for this company, great. Keep that belief, right? That's okay already, right? Because I am comfortable that I'm going to make acquisitions that can support the notes that we attach to it, right? So if that makes more sense to you and you say, okay, if today I wire $100,000 to EQK, we still have a couple payments to make to Anthony Morrison, our latest acquisition. Your money will be used there, right? And I shared the profit margins of this company last week. It's ridiculous, right? We're already running promotions right now, and the profit, the revenue is kind of, it is silly, and we're just getting started. So if that makes you feel more comfortable, that think about it that way, your money is used to buy one company with, you know, the P&Ls and history and predictions and forecasts attached to that one, right? And we will never make an acquisition if those numbers don't, pan out. Why would I buy something using people's money notes if the profit margins don't support or the cash flow doesn't support the payments? That's suicide. Like, why would I do that?
Yeah.
Right now, an additional layer, if you want to look at it from a broader perspective, and you're really looking for other ways to make you feel secure that your money is safe, then do take a step back and look at EQK as a holding company, because there's already 4 companies in it that have no notes on them. They're just, we acquired them with our funds, we own them, we make profit, right? So those 4 companies already support the 5th one.
Right.
And the next 10 that we're going to buy, not with your money, also go into that same bucket, and they all support each other.
Right.
Right. But again, if you're confused about it, forget about it. Just think about one company, right? If you want to think about an additional layer of security for your funds, then open it up and look at all the companies that we acquired with specific cash flow and projections and a belief that we're going to continue to make the same amount. Then it will make sense to you that it's a bit of a safer proposition than just one company, right? And then the next layer of security is the fact that it's convertible. If for whatever reason we can't pay the interest and the principal in the time that we promised, well, your note is going to convert into shares, equity in the holding company, the entire holding company, all the companies inside of that bucket. Now,
Right.
obviously, if that ever were to happen, we would have a third party evaluator come in, put a value on EQK, and then they would say how much the shares are worth, and you would get your number of shares equal to what you invested plus your interest, right?
Right. One
Now,
of the other
that's
questions.
to me, that's like the worst case scenario that could ever happen. I will not let that happen.
That I believe.
I don't want
Um,
to share. I don't want business partners in this.
One of the other questions we have, quite common, is what are the risks in this industry?
Yeah, the risk is that what we forecast, right? What the risk is, we look at a company, we look at the 3-year historicals. It looks good. They're growing every year. We like the profit margin. It's above 50% because that's kind of my minimum, which is very high for if you think about it. Um, the risk is that for whatever reason, I got it wrong. And the growth trajectory of that company all of a sudden, for a mysterious reason, stops.
Okay.
I don't know what that would be, but it could happen. I'm not, I can't predict the future. But that's the risk, right? That we get it wrong, and the numbers that company has been doing as far as revenue and profit all of a sudden change, and it drops significantly.
Okay.
But I
Okay.
don't know why. Yeah, again, I have no idea how that would happen.
Right. Right. So we actually have a Q&A question in here. So I just thought I would throw this in. Normally we do them at the end, but I thought I'd throw it in right away. It says, hi, how can you offer such high interest rates, which we kind of just discussed? More importantly, what are the underlying assets supporting P notes, promissory notes, and what are the total assets year to date? Lastly, what's the worst case scenario to ensure investors get their principal investment returned?
Yeah, I think I addressed all of that already, right? What's the underlying asset? Is the company that we buy with
Yeah.
the funds that you put in, and it's always going to be a fraction of what the asset is actually worth.
Right.
Because obviously, when I do the acquisition and I look at the numbers, it's just simple math. If I
Right.
know that the company is producing, let's say, $50,000 a month in profit right now, right? In 3 years ago, it was 40. Then it went to 45. Now it's 50. So it's been growing.
Yeah.
Well, then I know that I can comfortably spend 25,000 a month on paying the notes back, plus putting the principal aside. So I have it 2 years from now, and then I can pay everybody back.
Right.
Right. So that's the simple math that I'm going to do. So what is the asset supporting the note? Well, it's the company, and it's a cash producing asset, right? And I know it's sometimes difficult, and maybe Jake can speak to that a little bit, right? When you talk about alts, alternative investments, you kind of have to move away from the traditional bonds and stock and money market and real estate. Real estate is easy. You see a pile of bricks and you think that's worth something, right?
Mhm.
That's what everybody believes. It's been drilled into our heads. Save up enough money so you can buy your house. That's the safest thing you can invest in.
Yeah.
Well, is that true? Personally, I don't think so, but that's just my opinion, right? Um, but when you think about it, we're buying a cash producing asset. Every single month it produces profit, and it has been for at least 3 years. Otherwise, I wouldn't buy it. And I know exactly how much it's going to produce tomorrow or next month,
Yeah.
unless some black swan event happens, and yeah, then we're all kind of screwed, right? So
Right.
Jake, you wanna add something to that? Because I think that's important to hear from a professional who deals with this probably every single day with your clients, right?
Yeah, so let me give you a little background on me. I've been in this industry in financial services for over 17 years. I started with estate planning, business succession, wealth transfer, asset management, and I realized something very, very important about 5 years ago. And that is that my most wealthy investors, my wealthiest clients, all had one thing in common, is that they were investing in private equity, real estate, businesses, things that were not stock, bond, and mutual fund driven. Now, the traditional environment, the traditional world around us is telling us just exactly what Gus said. Save up your money, work really hard, buy a home, save, save, save. They're not telling us invest, invest. Now, about 5 years ago, I realized there was something out there that I needed to start teaching people, and that was how do the ultra wealthy become ultra wealthy, and how do the wealthy go from being wealthy to ultra wealthy? So I'm teaching people to level up.
Right.
And most people, I don't know who we have on this call, whether you're getting ready for retirement or you're young and you've done a good job of saving. But one of the most important things that I like about Toolbox EQK, this opportunity, is the fact that it's derived in investing in businesses that are heavily tied to information that is, for the most part, back to that saying, if the most important investment you'll ever make is the one that you make in yourself. Okay, this is stuff like Tony Robbins, Grant Cardone. These are the types of things that these info businesses are selling that people not only want to buy, but they need to buy them because they've got to invest in themselves. So I actually didn't discover EQK. One of my investors is the one that brought that opportunity to me. Now, when it comes to your investment portfolio, you have to make sure you're diversified, right? And then you also have to make sure you're diversified in places that are not going to correlate. So here's the problem we had with the stock bond and the mutual fund market over the last few years. We found that while stocks and bonds were not supposed to be correlated, and I'm going to throw out a quick disclaimer here, I'm not giving any investment, tax, or legal advice at all on this call. I'm just talking here. But what we saw is that stocks and bonds, while supposedly they're supposed to be uncorrelated. When stocks go up, bonds don't necessarily go up so much. When stocks go down, bonds kind of go up, right? Well, we saw a situation where stocks and bonds both went down. So you have to make sure you're diversified, but you have to make sure you're diversified in uncorrelated positions. Businesses are great, especially healthy, cash flowing, good balance sheet type businesses, which are the ones that Gus and his team are investing in with EQK. It's a phenomenal product. There's not a lot of employees. There's not a lot of overhead. There is a really good value proposition that's being offered by these companies. And it makes it a very strong place to look to gain some diversity in your investment portfolio. And one thing Catherine did not mention that I think is super, super important, she did a great job, by the way, but these things pay monthly. It's
Yes.
a 20%, 18 or 16% rate of return. The income starts next month. So you invest today, you get a prorated distribution amount April 1st.
Yeah.
So I have great opportunities, but a lot of those don't pay they pay quarterly or annually, or maybe they pay at the end of 2, 3, 5 years. This is a very, very good tool if you're seeking or wanting cash flow. So, but
Yeah.
yeah,
That's a
anyways,
great point. That's a great point.
that's
Maybe we wanna add to, and we want to explain why it's possible to do that, right? And it comes down to what I just said. We're just sharing the profit that that company is making with you as an investor. That's it. Because the company makes money every month. It's
And
not
that's
the
the
end of
most
the year,
powerful thing that
right?
Gus said is the fact that the info space, they're all working together. So
Mhm.
they're,
Mm.
you know, my list is sharing to Catherine's list. Catherine's list is sharing to my list, and we're sharing the profits. I'm getting a 40% commission on sharing to Catherine's list. She's getting a 40% commission selling on my list. But when I buy Kathy and her company, now
Mhm.
I get 100%.
Yeah.
And my profit margin goes up at least 40%.
Yeah.
So
So, from your side, Jake, was this your first introduction into this info space, into these types of businesses and seeing these kind of P&L sheets?
you know, funny enough, it was. And,
Interesting.
and the interesting thing about it is I'm the guy that reads the Tony Robbins books. You know, I'm the guy that's, you know, watching the Grant Cardone video. I mean, this is one of the ways I educated myself in alternative investments. And if you're on this call and you have not bought Tony Robbins' book, The Holy Grail of Investing, there's some very, very important information in there, which is that
Do we have an affiliate link? I think we have an affiliate.
yeah, let's put an affiliate link in there because it talks about the importance of using alternative investments in your investment portfolio.
Yep.
It's absolutely necessary if you want to get out of that riding the wave up and down, stock, bond, mutual fund, the old way of doing it. Oh my gosh, I'm so excited for 5 to 5.5%.
Yeah.
That's not keeping up with inflation, folks. 5.5%, you're still going underwater.
Yeah.
What are we going to do about that? What is your financial planner doing about that to make sure you're not in the stock, bond, and mutual fund markets? Most of the people that I work with, when I first start working with them, they're 90 to 95% into stocks, bonds, and mutual funds.
Yeah.
First thing you need to do, the first thing, you got to get out of the stocks, bonds, and mutual funds with probably 25, 30, and maybe even 40% of your exposure to the market and get into alternatives.
Right. We've had a lot of people on the calls who are inquiring that are currently trying to get out of real estate at this point. So they've got a couple of properties. The properties aren't performing. Syndications aren't performing in the same way that they thought they were originally going to, and they're now trying to get out. Would you be able to speak a little bit to that? Is that also what you are seeing as well, or?
Yes, absolutely. You just teed me up for a home run there. So
Sorry.
here's the thing, and you all need to spread the word. I'm going to preach a message here that all of you guys need to take to someone else that you know, love, and trust. Because here's the thing. I'm a national capital gains deferral specialist. So that's another role that I play in another National Carpenter Capital. And here's the thing, you can exit your real estate, your highly appreciated real estate. Depending on your situation, you do not need to use a 1031 exchange. You can exit your real estate, sell, defer the capital gains tax, and take that money and invest it in things like EQK and this opportunity.
Wow, I
So
did not know that.
let me repeat myself. You
Yeah.
can sell a business, you can sell real estate, you can sell a collector car portfolio, Bitcoin, individual stocks, literally any highly appreciated asset. You can defer the capital gains tax and you can invest in opportunities like EQK. And most people don't know that. Your CPA probably doesn't know that. Why don't they know that? Because they prepare taxes and they don't defer taxes.
Interesting.
So if you're trying to exit real estate and you want to get into something that's like what Gus and EQK are offering here, you need to talk to someone like me.
Okay. So I'm gonna jump back into our Q&As here. I've got one question, which is, what is the holding time? And I'm assuming that's for the monthly payments in reference.
Probably the term, so it's 2 or 3 years, right?
Right.
If that's what is referred to, the holding time for the principal, right? You would get into a 2-year note, meaning you get monthly payments, your interest for 2 years every month, and then the last month of that, 24 month period, you get your principal back.
Gotcha. Okay. And then we've also got another one from Peter Fisher. What are the motivations you find for business owners that are maintaining a minimum of 50% profit to sell their business?
Great question. A lot of it is burnout. They're so done with running this company because it's intense, as you can imagine. As a coach, as an educator, there's a lot of work to be done, right? And they're so stuck in that world, or the way they've been doing their business, that they don't really see how it can be transformed into something else. So I think burnout is the biggest one. And the second one, believe it or not, everybody we've acquired so far is now part of our team. And they actually own toolbox stock, because when we acquire companies, every single one so far has 3 layers to it. There's a cash down payment because they want to take some money off the table, right?
Yeah.
There's a seller note. So we paid them out of the asset. We paid them a monthly loan.
Yeah.
And then there's toolbox stock. So we could we could acquire a company that is worth $5 million and only pay 2 million, because
Right.
we have 1 million in seller notes and then 2 million in toolbox stock. So everybody believes in the vision of this roll up and they want a piece of it. So even though they're selling their company, they now get stock equity in the bigger picture.
So we haven't talked about Toolbox yet. So for any of those that do not know what Toolbox is, because we've been talking about EQK Holding Company, can you give
Yeah.
me a little bit of a description of what Toolbox is?
Yeah, the mothership is Toolbox, right? So the whole EQK is a holding company we created inside of our larger ecosystem, just to make it easy to talk about it, and to carve off very specific companies with clear P&Ls, with clear profits, and it's a bucket inside of the bigger Toolbox ecosystem. And it would take me a long time to explain what Toolbox has as far as assets and how that works, because that's a pure, private equity firm with, venture capital inside of it, startups, funds. We do trading. I mean, there's so much going on that that it's easier to talk about EQK, because that's just one bucket that is very clear and very easy to understand.
Perfect.
Now, it's worth noting, though, that EQK is, I was talking about those different layers, right? The company, the other companies, the convertible notes, you get equity. Well, there's also Toolbox still, supporting that, right?
Yeah. So
If
that
ever I'm short on cash and I have a choice between giving somebody equity in my holding company, or I take some money from here and pay it, I'm going to take money from Toolbox, right?
Yeah, so that's another question, is a lot of people ask about equity. Now, these people that you're purchasing, these companies that you're purchasing and you're giving them shares, will you at some point be offering shares to the public?
No, no,
No.
no. Well, we had at some point we had plans to go public, but now that we know different ways to raise capital and to grow the business, we have no intention to do so.
Okay.
It just overcomplicates things.
Right.
We,
And then another question that we often get is, can I roll over this investment into something else at the end of it?
I can't make promises on that, but yeah. I mean, most likely after 2 years, we'll still be working on something, acquiring something.
Right.
It's very likely that we would roll over those notes into another offering. Yes.
Right. Okay.
But I'm not making promises on that,
No,
but yeah,
no.
I could say that it's unlikely that we wouldn't have something like this.
Right. Right. Okay, so I'm gonna switch back to Jake if you don't mind. And I'm gonna ask Jake, what is it that you are like, why are you telling clients to invest in this now? Because first of all, it was your client that brought you on, which is fantastic. And now we know that you have also been bringing this to your own clients as well. Can you just tell me a little bit of what it is that you see and why you're bringing your clients on?
Yeah, it's an introduction I make because there's not a lot of opportunities in business where you don't have a storefront, where you don't have a bunch of employees, where you don't have a bunch of inventory, where you don't have a bunch of overhead, where the profit margins are so high, the balance sheets are so, good to look at. Before my first investor that brought this to me even invested any money, I mean, he was looking at all the balance sheets and everything. He wanted to know everything about the business. And the fact is you're investing in very, very healthy businesses, healthy cash flowing businesses with not a lot of moving parts to go wrong. And so I like I like it when investors are looking at investments with the highest possible return and the lowest amount of risk, right? That's what we're all looking for.
Right.
And the interesting thing about alternative investments as a whole is you tend to have to take less risk in order to achieve a higher rate of return. It's the absolute opposite of the stock market. And that's exactly the situation we've got here. Is when you look at these companies as a whole, and they've got one or two employees, and you look at their overhead and their net profits, and you're like, I can't even believe this guy's going to sell this company, you know?
Yeah.
Gus talked about why they're selling, but it's a reality. So some of these guys, no matter how profitable it is, they don't want to deal with whatever it is they have to deal with. ADHD or whatever you want to call it, they want to do another opportunity. They want to go a different direction. And this is like, having a little dog at home, you got to find a babysitter for when you want to head out of town. And so that's one of the reasons why I think it's an attractive opportunity for someone to consider is it's a business, it's investing in businesses, but these businesses don't have the normal moving parts of, they got a storefront, they've got 50 and 80 employees, and what happens if there's another pandemic and the storefront gets shut down and employees all get sick and profits go down and all this other kind of stuff. It's just a good, sensible type of asset to look at when it comes to the alternative investment space.
Perfect. So we've got another question in here which says, what is the human risk factor here? It seems you are the sole person running this. God forbid you have an issue. How will people get paid the returns and the principal?
Oh, wow. If I was the sole person running this, I wouldn't be sitting here. I don't know who's asking, but sir, madam, there's a team of 50 people running this company. And also when we buy the business, they also come with a team, right? So we're not just buying the asset, we're buying a running operation with people. The only person that typically disappears from the stage is the owner, but oftentimes they're not really doing anything anymore. Anyways, right? They have built it to a point where it is sellable, or they don't have to be 100% involved. But yeah, no, this is not the Gus show. If that's how it comes across, I'm the president of the company, but that doesn't mean I do everything. I mean, like in the toolbox portfolio, there's almost 100 companies, right? So I play a very important role in that, but it's built so I can take 2 weeks off and nothing will break. It's built that way.
Yeah.
So it's all prepared for longevity, and not dependent on myself or my business partner, G or Jake or Catherine, or right.
Right. Right.
I'm sure you can attest to that, right? As we brought you in, you can see there's systems in place,
Oh, yeah.
and we
Yeah.
can remove and replace pieces.
Yeah.
It yeah, we wouldn't be able to run a portfolio like this if we weren't skilled in, automation, scalability, right? That's what we do. That's really our,
And that's
domain.
actually a good point, because roll-ups, technically with roll-ups, that's the classic model, is that you're consolidating and centralizing a lot of those operations in behind the scenes, right? So you're using other parts of other businesses to help with other parts of other businesses, right? So not only have you got the, the cross-promotional aspect, but you've also got the cross-labor aspect
Of
as
course.
well, right?
Yeah.
Yeah.
Yeah, and typically the talent that we bring in through an acquisition is then deployed in those other assets, right? Because
Right.
the what is happening now is, because we're so heavily focused on marketing and, affiliate marketing and selling and on the EQK side, we are utilizing those resources on the toolbox side too, for all the other assets that we have.
Right.
That's just a natural thing. Everybody becomes part of the same team, and ultimately we are all focused on growing the portfolio rather than just one company.
Right. Right.
Everybody on our team is interested in what else is going on in Toolbox, right? What else is going on in EQK?
Yeah.
Yeah, I like working for this funnel building agency, but what is this Anthony Morrison thing, right? So that, and of course, we give people opportunities to grow into whatever role they see themselves play in that.
Yeah. Yeah. It's a great team. It's a great environment. Everybody is very collaborative. I've got to say that. And that's only from my personal experience, but okay. So one of the other things that I wanted to just touch on for people, I've had a lot of conversations with different people, especially that are, they're in their retirement years. They're usually selling off some properties, and they have a fair amount. Obviously, you have to be an accredited investor to even invest in here, which for some people, if they don't know, you have to have at least $200,000 worth of income in the last 2 years, or you have to have 1 million in assets, personal assets. So, but for some people, they probably don't know or didn't know really what alternative investments are, or what those could even look like. So maybe Jake, you could answer this question for me. What are some examples? Now, we know EQK is an example of an alternative investment, but what would some other examples be?
Yeah, so the simple and easy answer to that is anything outside of the traditional stock, bond, and mutual funds.
Okay.
So it could be hard money lending, it could be promissory notes, it could be investing in a REIT, a real estate investment trust. It could be investing in a limited partnership syndication. It could be, um, you know, uh, there are some deals I put together where I got folks that have money and folks that have land and a contractor that wants to build, and we just put the deal together and,
Right.
so anything outside of stock, bond, and mutual funds. And if you look at the history of alternative investments, there are some big syndicators. There are some big REITs out there. Me and my investors tend to steer away from a lot of money going into the big syndicators because they tend to be a little bit more corporate. There's a lot of, storefronts and employees and overhead and things like that. So there tends to not be so much return to the investor, or there's more things that can go wrong. The smaller to mid-sized, I'd say this is another thing that I like about EQK is they're not huge. They're not this mega conglomerate you know, and they're growing and they're hungry and they have a really, really clean process. But the smaller to medium-sized opportunities, these guys have their finger on the pulse of what's going on in the company, what's going on with the opportunity, what the investors want. That, you know, what I like is I can call Catherine, I can call Gus, I can reach these guys if I have questions, you know, that my investors are asking me. You know, so that's kind of another element, is something like a small to medium sized opportunity. Could be like a limited partnership in real estate, maybe multifamily. You know, this is a great one in business. Some people are going into like mini storages, light industrial type stuff.
Right.
Funds too, right? Just general funds where you get you know, an LP position in the fund. That's another one.
Yeah, they may have a variety of different assets in the fund, from multifamily and you know, light industrial, mini storages, and single family homes, and you're just an LP investing in the fund, and you own a share of the assets in the fund.
Right.
But it's interesting because they call that alternative investments when, you know, I would say, you know, investing in business, you know, business and land has been around a lot longer than the stock market. So in my opinion, I think the stocks, bonds, and the mutual funds are more of an alternative investment. You know, you need to know if you're in retirement or getting ready to retire, folks, the strategy that you had is not going to work when you're in retirement. It's just not going to work. You were contributing, you were getting a company match, you were dollar cost averaging in the market. That was going to work. You were focused on averages. That's not going to work anymore. Now that you've taken that money, you retired, you're no longer contributing, you're just riding the wave. So the problem with that is its order of investments, order of return is more important than average returns.
Right.
And that's where the alternatives come in, is they tend to be a lot more predictable. They tend to be a lot more, we know what we're going to get when we go in. We know how long we're going to get it for the most part. And so it's much, much better for generating income in a lot of these alternative spaces. And EQK is fantastic because it's monthly.
Yeah, that's a fantastic point, because it can really make a huge difference when you're retiring on the year that you retire, depending on what the market is doing, if you're in mutual funds and stocks and stuff, right?
You're all in stocks, bonds, and mutual funds, and you got to rely on that for income, and the market's down for 1 year, 2 year, 3 years, or whenever you're looking to pull money out.
Oh, he just froze.
You either better live on beans and rice, or it's not going to last. And if you ask your financial planner, I know because I do retirement planning, if you ask your financial planner, out of my stock, bond, and mutual fund portfolio, what is the safe withdrawal amount percentage? They're going to tell you 3 to 4%. If you pull more than 3 to 4%, you have a chance of running out before life expectancy.
Wow. So it has to be there. It has to be constantly producing. Oh, it looks like you froze again. Sorry.
Can you hear me?
Yep, you're back. Good. Okay. So that brings up a good question. He's kind of freezing again, but I don't know if we'll get him back in time.
What that means is you have a 50%. Am I okay now?
Yeah, you're good.
So not running out before life expectancy is like getting on a plane that's got a 50% chance of going down before reaching your destination. And then you get a 3 to 4% withdrawal rate. In my opinion, equities, stocks, bonds, mutual funds are a good place to leave your tomorrow money, where you need to keep it liquid, where you don't have to pull off of it for income, because if it's up, you pull. If it's down, you leave it alone.
Right.
Opportunities like EQK, some of these other alternative investments that provide steady, predictable income, you know, those are the places that you want to get your income from.
Right. So that brings me to a good point. A lot of people have been asking about IRAs and taking money from there and putting it toward EQK. What are your thoughts on that?
Absolutely fantastic. In fact, we just moved some IRA money over, right, Gus?
Yeah, last week.
So here's the thing. If you're currently working at your employer right now,
Mhm.
and you're 59 and a half or older, more than likely you can do something called a non-hardship in-service withdrawal. I just met with a guy last night that's going to do this. He's got about 520,000 in his 401k at work. He's planning on working another 6 or 7 years. He's turning 59 and a half here shortly. He's going to pull that entire amount out of the stock, bond, and mutual fund portfolio inside his 401k. And we're going to go into a, pay attention here, self-directed IRA.
Mm-hmm.
Penalty-free, tax-free, company-to-company transfer into a self-directed IRA with the entire balance. He's going to leave his 401k open at work. He's going to continue contributing 13%. And because they did away with his pension, he's going to get another 12% match on top of that. So he's going to keep doing the 401k thing. He's going to keep putting money in. He's going to keep having a 401k, but he's just taking the exposure of the market and he's removing that. We're going into a self-directed IRA. Then we're going to diversify that into EQK.
Just when it got interesting.
Happened twice now when it gets interesting.
Yeah. Well, you're basically saying that because I know you're talking about a variety of alternative investments through that. Yeah.
Right.
So,
and just to give people some an idea, if you're taking 500,000 and you're doing it on a 3-year note, that means that you're actually getting $100,000 annually, which means you're getting $8,333 a month. So, so I would assume that taking the money out of the stocks and bonds that he currently has, I mean, he's getting a lot more return by doing this with EQK, right? So there's just no comparison, right?
absolutely. You're absolutely right.
Right. All right. Well, we're down to our last 6 minutes. Normally I open up the questions sooner than this, but we've only got a few in here. If there's anyone that has any questions and they'd like to get those answered before we end the session, we're going to be ending the session at 11 a.m. Pacific Standard Time.
I'm running to my gate.
Are you running? Okay.
I'll be running, yeah.
Lace up your shoes, guys.
You don't have the kids with you, do you?
Nope, just me.
Okay, you're good. All right. So yeah, so self-directed IRAs, that is a possibility. One of the things that people have to do is they have to check with their custodian in order to make sure that it is a true self-directed IRA. Now, one of the other things I wanted to mention too is that, Jake, you have offered to have conversations with people as well. I know you're not part of the EQK team, and hopefully
We'll give him a t-shirt. I don't know.
I had told Gus, Catherine, I've shared with you, and I'll share all of you that are watching. If you need any help with capital gains deferral, if you need any help with self-directed IRAs, I do all that on a regular basis. Gus and Catherine are more than welcome to forward you and put you in contact with me. I work with certain custodians, 1031 facilitators. I do all of that. And I make sure it's done right so you don't get any kind of tax issues or penalty issues. Again, I've been doing it for over 17 years. So I'm more than happy to be a resource to anyone that EQK wants to put me with. And I can share with you how a lot of my clients have utilized EQK to create a powerful opportunity for themselves.
Perfect. That's awesome. Thank you very much. Sorry, we have one more question in here, which is, what types of companies are you targeting to buy now? AI, question mark?
Oh, it's almost hard to not run into AI opportunities. Yeah.
Yeah.
There's a couple in the pipeline. Yeah. I actually was going to talk about that last week. I had that all prepared. We have 4 solid targets lined up. Once Anthony Morrison deal is completely paid off, which will be probably by the end mid-April, then we have more of the same, I would say, just info products and lists. That's what we're looking for, right? More products to sell to more people that are already interested in info products. So there are some AI courses in there and tools in there.
Yeah.
The first one I'm really excited about is we'll call it, because I can't disclose too much because it's still not done, right?
Yeah.
Call it Celepco, which is a company that has been dabbling into creating courses for celebrities, so
Right.
that you're leveraging their followers, right? For example, and what's neat about it is that they're not creating a course that you would expect. We did one with Mike Tyson, super fun to work with him. And but the course was not about boxing. It's not like master class where they teach their skill. Mike did something about resilience and grit and strength and being super focused on your goals and your targets, right? It was called 12 Rounds with Mike. And I mean, it's actually out, you can buy it. And it's not a boxing class. It's how did Mike become who he became, right? How did he go from the underdog, people telling him you will never amount to anything as a boxer, you don't have to body for it, to being like probably one of the biggest in history, right?
Right.
So that's the next company we're targeting.
Right. Okay. And then we've also got a question from Shad who says, how much has been raised to date?
We just got over well, do we include the additional 260, Jake? Then if yes, then I think it's 99% sure. We just crossed the 1.6 mark, plus another 260 coming next week.
So 1.6 million
Yeah, plus 260.
plus 200.
1.86,
We
1.86.
got 610 coming this next week, so.
Right, right. So it is moving. So that's another, I know I've only got 1 minute left. I always have too much to talk about, but that's another question that we get is how long is this offer going to be on the table?
Well, as long as there's opportunities for us to buy, right?
Yep.
That makes sense. Then we're going to keep doing this.
Right.
So I would assume at least till the end of the year.
Okay.
And then after, like I said, it's not about, we're not trying to just raise for one particular thing. We're raising capital to make a dent in an industry, right?
Yeah.
So where does that end? Well, when the deals stop flowing and when the money stops flowing, then we're done, right?
Right.
There's another thing to consider is once our portfolio starts producing so much cash that we don't need to raise anymore, maybe we'll do less, right? Maybe we'll take less notes because then we have our own cash that we don't have to pay 20% or 16% on. But would we ever get to a point where it doesn't make sense to add the notes? No. That and Jake can probably confirm that, right? His wealthiest clients still do loans,
Yeah.
right?
Yeah.
It's not always a good thing to use your own cash,
Right. Right.
even at a 20% interest rate.
Well, and there's a lot of us out here that would really like you to make us money. So if you could keep going, that would be great.
I'm happy to. That's part of it. That's part of why we do this.
Yeah, yeah. All right. So we are 1 minute over. So I just wanted to say thank you so much, Jake,
Yeah,
for bringing in some of your expertise. I can almost guarantee that we're going to ask you to come back again. And also thank you very much, Gus, for being on the call. I know that you have to run to a flight, so we're going to end this really quick. It was great. If anyone has any information or they have any questions, feel free to reach out to me. And We are also doing webinars every Thursday. So you can come back every Thursday at 10 a.m. Pacific Standard Time and watch the next topics. We send out the notifications through email. And on the weekend after the last webinar, we also send you an email that gives you the recording from the previous week. So if you've missed any and you're just getting started or whatever, feel free to contact me. I can give you those recordings or go back and check your emails. All right.
Right.
So thank you both so much. We
Bye-bye.
really
Thanks for having me on,
Thank
Ryan.
you. Bye-bye.
thanks. Bye-bye.